Happy New Year, 2020, new year, new decade. Are you ready to go? We're going to do a wrap up of 2019. Everyone was winning because it was easy.
That was easy.
It was like a walk in the park. Was it though? We have lots to talk about today, so sit back, grab a cup of coffee, let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. So we're going to talk about what's coming up in 2020, little wrap up on 19. What is our agenda? Right here, we're going to talk about the big charts, where our signals are. I don't think you're going to be surprised. We're going to talk about bonds. We're going to talk about what keeps me up at night. Yes, there's still several of those. And sector highlights. Let's go to the big charts. All right, first up, new chart. You have to understand, here at Wealth and Wisdom, Loftus Wealth, we work with pre-retirees and retirees. So it's not just about accumulation, it's about distribution, income. Okay, so when I look at the long-term view, that's what we plan for, okay, as we get our clients their income. So if you look at the long-term view, here's October 1st, 2018 to the end of the year. The orange line is NYSE, the broad market, truly up 6%. S&P up just around 9% year over year. So let's think about that. Yes, we had a wonderful year this year, but everyone has a short memory. So when we're working with clients, let's say here, market was down 20%, 19.83 actually, but let's say 20%. You have $100,000. You lose 20%, you have 80. Pretty simple math. You make back 20, you have 96,000. So you actually need to make 25% just to get back to even. So that's what we have to be mindful of. When it comes to retirement savings and income, it's a long-term game, and this is what we work on here at Loftus Wealth and Wisdom. So let's get to the big charts here. Clearly, we are still in a secular bull market. There's no doubt about it. The longest bull market in history, maybe a tired bull market, but nonetheless, we are still in a bull market. So let's look at the monthly view first. So I'm going to do it backwards this time. What do I see here, if anything? Obviously, down here, we finally got that momentum switch to the upside. Momentum went positive. This market continues to go up. Anything concerning? Right here, we've talked about this, negative divergence. So this is relative strength. As you can see, you have a series of lower highs. So we're making all-time highs with lower levels of strength. So that's a little bit concerning, maybe not short term. Next, we have our midterm weekly view. Clearly, we've had a breakout here. You can see it, positive, no doubt about that. So let's take a look at the short-term view, and here is where we look at the S&P. Now, anything going on here? You know, last week, we got really overbought, okay? We're talking in the 85, 86 relative strength range. That's really overbought. Obviously, we had a little pullback there in a couple days. Anything else of concern? You can see things turning down on momentum. And you know what? VIX, Volatility Index, continues in that 12 range, 12 to 14 and a half, not really breaking above 15. That's when you look for a change in the market. But still, all of these are positive right now. But for me, going into the new year, I still have some concerns, and we'll talk more about that in a second. So last up, let's talk about the strength of the market. What's underneath? We've shown this for some time. Here we have your S&P, which continues to go up. The gray histogram is your new highs minus new lows. Now, when we were making new highs last year, we're up in the 400 or 500 range. We just haven't seen that. The other day we had, last day of the year, 167 new highs. So we're still not seeing that oomph, that real big push. So a little bit of concern, not a lot, but it does keep me on my toes. Next up, let's talk about treasuries. Big move here in as much that we never went above 3%. So many people, the bond king, etc., really were looking for that 2.5% to 3% push on bonds. We never got it, okay? That being said, where are we? We're at 192 on the 10-year treasury. That's not so bad. I think we actually go lower into the second quarter. We'll get there eventually. But I think the biggest thing that everyone was talking about was recession and recession indicators, okay? And that comes from your 10-year treasury minus your 2-year treasury. If it inverts, goes below zero, those are recession signs. We're up to 0.34, so we've had a big push back up. So right now, recession is not on our radar. We're not going to worry about that. Next up, what keeps me up at night? All right, so what keeps me up at night as we head into 2020? Whew, there's a few. So listen, there's a couple parts of our process, our investment process. If you like what you saw, hit that like button. That's going to help us. But it's not just about the charts. It's also about the fundamental, the macro data that we see underneath. So first up, earnings. Earnings, negative. Negative earnings for the third quarter. All right, now think about this. We've got negative earnings and the market just surged. That's a big disconnect. So I have a concern about that. Next, the biggest story of the year, the Fed. So let's go to the Fed and look at what they've done over the last couple years. So they started raising rates, no problem, okay? Then we had quantitative tightening. So they're letting the balance sheet go down, burn off all those assets. Then they started raising rates, okay? Now we're at 18. So quantitative tightening, you see what's happening. It's getting choppy, going sideways. Then, of course, here's our peak in 2018. So they started at 175, okay? 2.25, 2.5. And then here's the big one. The Fed flip-flops a year ago this week. And that's really what started the first surge. And then they started cutting rates. So here they're going to start raising rates. You need that ammunition for the next recession or pullback. And they cut rates. And then the biggest story, not QE, where they start dumping money into the system. So let's take a look at that. Here we are. End of the year, how much? How much money did the Fed put into the market? So we started here September 21st with not QE, the repo, the liquidity. I have that in my last video. We'll have some articles. The bottom line is by the end of the year, the Fed put $407 billion, that's billion dollars, into the market for liquidity. If they didn't, what do you think would have happened? I got to tell you what would have happened. It would have been ugly, okay? So now, let's overlay them. Hopefully you can see this. I've got the S&P in the back, and then I've got the Fed, and the impact is huge, okay? As they start dumping money into the system, the market goes up. This has been a Fed-driven market, period, end of sentence. Fundamentally, not good. The Fed is driving this, and the word is we're going to see another $500 billion between this week and next week. That's ridiculous. That's going to put us at levels above the money we put into the market after the crash. This was the number one story in 2019. Still the number one story right now, because if they stop, it's going to be real interesting. Next up, again, let's look at underneath data. Well, if they've given all this liquidity to the market, to the banks, they should be loaning. Well, no, look at that, okay? When you go back to that, real quick, the trend is not your friend, okay? So if they're not loaning, right, liquidity, what are they doing? Well, let's look at some other things. Oh, the consumer's doing great. You know, they're really not. It's peaked, and we're heading down on a lot of these areas. So everything we look at here is year over year rate of change, okay? And you can see the peaks and how we go lower. Next up, charge off on credit cards. Now, not a big move, but a move nonetheless. Very similar here down to 2015-16 when we had a correction. This is another item that we're going to continue to watch. And another. Here's another behind the scenes high yield market. We are down now to just 4%, a little bit less on high yield. The idea of high yield is you're willing to take that additional risk for a higher yield. We're not seeing it. But the biggest thing is, there's your peak, right? We talk about everything peaking in October of 2018. This going up are delinquencies. So the high yield market is starting to show some cracks. Not a lot, but we'll continue to watch that. Last, manufacturers' new orders. Guess what? I mean, look at some of these shipping companies at the end of years. If orders are down, shipping is down. See how it all works together, right? You with me? Next up, sector spotlight. All right, so sectors. When you look at sectors, you have to look at some other factors. This is new. I'm sharing it, okay? We talk about cycle investing. And you look at that and how I go into certain cycles, right? When growth accelerates, inflation accelerates, etc. So where are we right now? We're down here in the corner in the third part of the cycle. Growth slows, we're seeing that. Inflation accelerates. Fed is neutral, no doubt, okay? Markets, stagflation. Well, we're not seeing that because of the Fed is dumping in. So we went from fourth quarter, this is where we are. We expect to be here first quarter. We were here, okay, in the third quarter and expect to go back there the second quarter. So we take this data and then we go ahead and we manage or we look for opportunities based on that cycle. So let's go to the chart real quick. All right, so follow me. Going to have a little fun here. CRB index, commodity index. You can see, right? Look at this. I mean, that is truly a trend change. So this means the prices of commodities are going up. So let's look at another chart real quick. So the first one here, haven't talked about this, but the US dollar. If you're not aware, the dollar's been breaking down, okay? So we peaked, okay? You peaked dollar in the fourth part of the cycle. In the third part, where we are now, it starts going down, and you can see a series of lower highs. Now, when you look at that, again, from an investor standpoint, when I'm looking at opportunity, I look at correlation. So if something's 100% correlated, it's going to move together, right? So the S&P and the small caps move together, we'll say. Now, how about here? Down here, I have the commodities index correlated to the US dollar, okay? Follow me? Negative 0.75. So that means it's negatively correlated, goes the opposite way. So follow me. So here's the thing. When you think about commodities, you think about oil. You think about gasoline. At the pump is where you're going to see it. So when you're thinking about rising inflation, one of the best places to invest is oil. Now, let's go take a look at the chart. So let's look. Now we go to the chart. What do we see? Oil. Talked about this before. This is a reverse head and shoulders. Very bullish, right? Look at the other thing. Here's your trend line. We broke above a trend line. So oil has been really strong. In fact, this month we're up about 6% in oil. That's a nice little hit. Now, the other thing I look for when I'm looking to buy oil is volatility, which is down here. Okay, when it's below 35, we like oil. Now, let's do one more example. So here's the thing. The way the government looks at inflation, the way that you and I, as consumers, look at inflation are two different things. Where do you feel inflation? You feel it here in the cup of coffee. So now let me show you where you're really going to feel it. From the coffee line to the coffee charts. What do we see here? Well, look at that. Look at those prices going up. Now, personally, we did not get in. I'm looking for an entry point, but you can see the impact of inflation. So when we look at cycle 3, where we are, inflation accelerating, which we see through the first quarter, there's opportunity. Livestock, cocoa beans, coffee, oil, to name a few. If this is what you're looking for, this is what we do for our clients. Hit that like button, click below to schedule an appointment. Let's wrap it up with fear and greed. 2 weeks ago, 3 weeks ago, 76, 93, 93, highest number I've ever seen since I started using this a couple years ago. A year ago, we were at 12. Total fear, chaos, just kidding. But we are at 93, that's really high. All indicators are positive right now, short-term, mid-term, long-term. Game plan, still holding a little bit of cash. Let's see what happens. We saw some cracks at the end of the year. Everyone was trying to dress up their portfolios. The fundamentals don't look good. So again, it's a good time to stay nimble. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.